Welcome to the Finance Podcast. The topic of this episode, the role of fixed income in asset allocation by Dr. Agim Xhaja, Lennart Lengeling, Manuel Streiff and Claudio Paonessa, moderated by Stephan Meier.
Good afternoon and welcome to our panel discussion on the role of fixed income in asset allocation. My name is Stephan Meier. I work at Zwei Wealth, mainly responsible for developing the institutional business. Before we start, I would like to quickly introduce the panelists. Starting all the way to my left, it's Agim Xhaja. He's the CIO Fixed Income at Banque Cantonale de Vaudoise. He has 14 years of investment experience, began in 2001 at UBS, had various positions in...
2001, 2025 is 24 in place of 14. No problem. Just to I know you are reading the text, so but we.
That's true. Yeah, sorry.
Never mind.
So you have a PhD in finance from the International Center for Financial Asset Management and Engineering at the University of Lausanne, a master's degree in international economics from the University of Geneva, and a degree in math from the University of Tirana. Then to the second, in that sense, next to Agim is Lennart Lengeling. He's works in the investment strategy at Algebris Global Opportunities. He's an analyst in the Global Credit Opportunities team with a focus on G10 rates. He joined Algebris as a risk analyst in 2018 and moved to the investment team in 2020. He's got a Bachelor in Science in Business Administration from Goethe Universität in Frankfurt and a Master's in Quantitative Finance at Bocconi in Milano. Prior to joining Algebris, he worked at Eurex, Commerzbank and Goldman Sachs, and he's a CFA charter holder. Then next to Lennart is Manuel Streiff. He's the founding partner and CEO of GAMA Asset Management in Geneva. He was a long time before he founded, in 2019, he founded GAMA with a few partners. He headed the fixed income franchise at Lombard, where he established a solid, unconstrained investment framework that led to successful performance and asset growth over 18 years that he was at Lombard. He started his career in 1998 as an economist for Synthesis Bank, and he's also a CFA charter holder and holds an MA in International Relations from the Graduate Institute of International Studies in Geneva. And last but not least, to my immediate left is Claudio Paonessa. He's a senior portfolio manager at the Basler Kantonalbank. He joined there in 2021 as a senior portfolio manager. He heads the fixed income portfolio management team, which manages all bond mandates and funds. Previously, he worked at Xhaja and at the pension fund of the city of Basel. He's a certified FRM, a financial risk manager, and holds a master's of the University of Basel with a specialization in financial markets and monetary policy. So with this, I would like now to turn to the topic, which is the role of fixed income in asset allocation. And I would like to start with one question to all of you before we then go a little bit further. But maybe we can start it off. What do you see as a primary role of fixed income within a well-diversified asset allocation? If you could just, in a few short sentences, say, how do you see that? Agim, you want to kick it off?
Means first, when we speak for asset allocation, we have in mind, treasuries. Let's be concrete here. Treasury, hedging properties of treasuries. Means when the stocks are not doing well, you load the portfolio with the treasury, and this is the role of asset allocation in big terms. So then we can have a different type of asset allocation, more extended with other class. But the classical role, this 60-40 or whatever terms you have heard, is this. Now, the question that is asked here is that are those treasury are having this hedging properties when equities are doing well, are going. And then just to make a little bit of framework, we have had two periods, the last 40 years, because we'll not go 100 years before. We have been from 1980 to 2000. How was the correlation between stocks and bonds? Positive. We have a period, 2000, 2020. How was the correlation between stocks and bonds? Negative. Where we are after 2020s, we have begun to come a little bit positive. When this correlation becomes a little bit positive, the hedging properties of those US Treasury begin to weaken in this part. What is the factor? Because I will not kill on the panel to stay long. What is the factor? What has changed? Apart, we've heard about this real rates, we've heard about this inflation. And this is the third element that when we speak for interest rate or for bonds, is the term premium. The stuff how much we'll charge over the short term on this part of the thing. And these term premiums need to pick up. And this is the part that weaken a little bit right now as we speak, as this correlation turn positive, the hedging properties of the treasury in a classical sense. So this is a little bit the challenge. When this stabilization, when this normalization will go through, when we'll get enough the term premium, yes, will be some hedging properties in the simple term of the phrase. So this is a little bit just to start the panel. So I leave to my colleagues to follow
yes,
up.
absolutely. So totally agreed with that, exactly. I mean, for us, fixed income in a portfolio is absolutely necessary. It's a great asset class. It adds diversification. And exactly, why would you hold fixed income in your portfolio? For three reasons, right? One may be the hedging properties that we just discussed. The other may be just the carry that you're interested in, or some price performance, right? And so we'll get to the macro backdrop in a bit more detail in a minute, I'm sure. But exactly as you just alluded to, the hedging properties are questionable at best for government debt at the current stage. Just harvesting carry is not obvious because your carry to volatility is not great at all at the moment, right? Given the massive amount of rates volatility and macro volatility that has returned to the market. And then performance becomes very selective, right? Because you'll have winners and losers within the credit and fixed income market. And basically, you need to follow a very active approach in order to differentiate the two. And so for us, fixed income is a very attractive asset class at the moment, but also quite a selective one to follow.
To complement, I would add basically that because we are talking mainly about equities and bonds, which are on one side floating cash flow generation, equities depending on the growth, and you have your EPS growing. While on the fixed income, by definition, you get fixed cash flow. So the key information here is whether you're happy to complement for the risk diversification in your equities, which are the main source of your risk over the long run from a balanced asset allocation point of view, if you want to complement with a fixed cash flow return. And that's, I think, there are two components which are very important from that angle. Is the first is the correlation between the two parts, and we mentioned, Agim mentioned the importance of the correlation, and the main driver of correlation between equities and bonds are inflation. In a falling inflation regime, you will tend to have this normal correlation. But when inflation is increasing potentially very high, you don't like to have for both equities and bonds. If you're in between, as we were before the big correction in 2022, you had something balanced between those two. So inflation is very important. So your question as asset allocation is whether you see inflation structurally lower, stable, or higher. It will help you in the framework. And the second element, which seems a little bit obvious, is how much you are paying on the fixed income. So you look at the risk premium that you get on the fixed income part. It's not only treasuries, but it's also credits. So you have a combination of those risk premium. And on the other side, how much you are paid on the equity side. Knowing that it's going to be increasing, but how much you are paying one vis-a-vis the other. So I'll stop here, but that's for me the two main driver of your decision in terms of asset allocation.
So Manuel already mentioned the complement of fixed income in asset allocation or in the portfolio. For us, especially as we have a large retail client base, but also an institutional client base, it really serves not only as a complement to equities, but it also serves as a risk, let's say not reducer, but as a risk moderator. So that's one part fixed income comes into play within our asset allocation, especially because I have to also talk for our clients. And the other thing, I think it really comes down to carry. You already mentioned it, all of you. And Agim, when he started, he spoke about the different decades. And when we are looking back, and carry has been, let's say, destroyed a bit during the times after the dot-com, but especially after the financial crisis. And I think we see a return of carry. And that's most simply spoken, that thing that we can also show to our clients, that they generate cash flows, that they generate a yield back on fixed income. And that helps especially those that are having needs when they are going to retire. So that's also a role we see for fixed income in the portfolio. Coming back to you, Stephan.
Yeah. Maybe we can stay a little bit longer on the statistics that you gave at the beginning with the 20 years prior to 2000 and after. So how has the role of fixed income changed over these decades, and more importantly, what do you see for the coming years? We're looking at where we are now.
Yes, I can, but okay, I can continue, okay, on this part. So, as we said, we have had this normalization. Everybody remember 2020, after COVID, the lowest level that we reach in yield. Sometimes we reach this negative yields in Switzerland and the other, this was the part. Since then, we have begun to reconstruct, to build this stuff that Claudio was mentioning, the carry. So we begin a little bit with this normalization of monetary policy. We try to capture all those elements of inflation that we got there. And as I mentioned, the third part of the thing that is coming is the element of term premium. This is the part that is trying to recollect. Are we done in this process? Not yet. As we see the world today, as something was mentioned here that Paolo mentioned, carry is coming back. So what do we believe? In which world we are going? Which one will be most retributed? Capital or labor? Our guy there from US there is telling us that labor. Now let's try to trust face value without entering in the debate. Is labor. So capital need to price a little bit much higher. Until now, we have priced quite a lot capital. So if you come in the capital in the market with the capital, you have been attributed on this part. Now, in this new configuration that we are trying to build up, at least, the capital will be treated differently compared to the labor, which is a good news for the people, institutional clients, for pension funds, that will come more, the capital will be priced more dearly, which means more carry for bonds. This is what Paolo has in mind. So this is the future that is coming on this type of things. Right now, short term, don't look because it's different type of flow, different type of movement in the market, different type of current. But in which age we are living? Means you remember 2020, age of scarcity, supply chain disrupted. We are still seeing, okay, since a couple of months, still this supply chain realigned, doing the others. The stuff that you hear, demographics, what is the name of the game? Labor shortage on this type of thing. All those type of things point to something which is very crucial and then was mentioned a little bit by Manuel there, that when we analyze bonds, we have two type of shocks. We have type of demand shocks that are coming, means that when economy, as we used to have the last 20, 40 years there, that economy was suffering on this part and the central banks try to enter and do this type of stuff, okay, on this part. But we have those supply shocks. When you destroy a little bit the supply chain, this is supply shock. When you have this inflation that is peaking, when you have this labor shortage, those are supply shocks. And this is different. This is what makes a little bit this inflation to come a little bit more difficult back. This is what it means a little bit that this term premium need to be rebuilt. Those are a little bit our challenges that we are facing on this current economy and the others. And this is the opportunities for us in fixed income. Let's turn back where Paolo was saying, okay, we'll have more carry in the future because capital will be priced differently. Are we there yet? Not yet, but we are tending toward this distinction, and everybody should make its own bet on this type of things, which world is seeing going forward. But those are the stuff.
Just to rebound on what he said, because to create a sort of a debate, because I tend to say that importantly, the key question would be where will be nominal growth in the futures. And then we mentioned demographic. I tend to say that demographic will lower potential growth than increase the inflationary pressure, but this is a long debate. I think nominal growth is the key. And the thing that happened over the past 5 years, just prior to the big correction that we have, is that you had central banks were printing at 10% over. So you take the liquidity in the system, it was 10% per year. So even if you get 5% on the bond side, what is your true risk-free? Is it 5%? No, it's 10%. Because as a purchasing power, if you have $1, you want at least 10%. So on the bonds, it was impossible to get there. So I think the key, and we had, I think, not to enter too much into politics, but just to point what's going on right now, you have a Trump that say, okay, fiscal policy, I think we are reaching the limits, so we don't want fiscal policy anymore. And printing at 10%, we don't want that as well. So if you taking out the two main sources of nominal growth in the system, you end up really badly. So coming back to the question, do you want to have fixed cash flow or floating cash flow in this world? Personally, I prefer fixed cash flow. You have the visibility, you get paid at the end. You are well paid because corporate bonds give you some good things. On the floating cash flow, it depends on which equity side, etc. But I think the key question is there. Where do you see nominal growth in the future? And what would be the driver of nominal growth?
What I would just add there, though, if I may, is that, we probably all agree to this, the growth outlook globally is very, very uncertain, right? I mean, from the tariff impact now, from the announcements that we just had yesterday, surely will have a negative growth impact, but at the same time, they seem to be quite inflationary, depending on over what time frame you look, right? And so nominal growth, I totally agree with you, but basically we need to almost differentiate between real growth and then where inflation is going. In a lot of the US data and survey data, especially that we're seeing lately, growth is falling off the cliff, new orders, all of that in the ISM indices. But inflation expectations are rising quite a bit depending on what measure you're looking at, right? And so in a stagflationary environment, again, it's not obvious what kind of hedging properties you have, especially in government debt further out the curve. And it's almost a curve steepener type of trade for us, at least, whereby you think a growth shock will near term definitely hurt the economy. So you potentially see global central banks cutting rates further than is currently priced. But then further out, we're talking about potential structural inflation drivers, growth outlook. Yes, you have demographics on the one side, but now you have massive fiscal spending outside of the US for sure anyways. So for us, and it's been a theme that has been around now for quite a while, but the curve steepener in fixed income is still quite attractive, we think.
Okay, let's move on to more specific topics. We talked mainly about treasuries, but you also brought corporate bonds as a potential investment. How do you see the different groups of fixed income investments, and how do you use them? Corporate bonds, high yield bonds, emerging market debt. Which do you find particularly compelling, and why?
So maybe I can just jumpstart to your question. We have been a permanent advocate for the corporate bond space for some years now. For us, we have a quite different playing field than maybe the other participants in the panel with their clients. But for our, let's say, for our Swiss institutional retail base, we really stick to the high quality end of the space of credit. So especially talking about global corporate bonds. Why do we like them? We like them because we see the global corporate environment as, although we have current tough times, as solid and robust. The recent 15 years, the companies used the environment to refinance on a very low yield level on their debt they have to pay. And I think this gives them very much room for the future, for a further deterioration in the fundamentals on the earnings side. This is the first thing. And also for the all-in yields we see currently in corporate bonds, even though the corporate bond spreads, if you compare them to treasuries, they are quite, let's say, tight in historical comparative. The all-in yield for an investor is still around 5% in US dollars, which is carry. I come back to that content back again. So I think I leave it there because we cannot go for high yield and for, let's say, for the lower quality space for our clients, but I think that may be a topic for yours.
I mean, Lennart, yours is called credit opportunities.
Yeah.
So where are these
right.
credit opportunities?
That's right. So our fund is a global credit opportunities fund whereby we can go into all the different spectrums and areas within credit wherever we see fit. What I would say currently, we are quite on the defensive side of things. So there's two themes for us. One, credit is generally quite rich. Credit spreads on market level are quite tight, as you already alluded to. And the reason for that is that because investors look at the absolute yield, they're saying, hey, I can still lock in 5% in dollars. That's great. I think the Fed will cut. So happy to lock that in. That's absolutely true. Just in our view, we also see quite some dispersion within credit markets, right? Which then lead to overall the market being quite tight. And so given fairly high levels of dispersion, one topic is the theme of maturity walls. That's been an ongoing theme now, but all the companies that financed themselves very cheaply during COVID are now coming up to their refinancings, and there are winners and losers basically, right? So you have a lot of these bonds with call dates, within the next 6 to 12 months, where you still have very high coupons, 10, 12% type coupons, they're trading slightly below par. And they are very idiosyncratic stories, basically, where you need to do the fundamental bottom-up credit work. And then you can make, 10% on an annualized basis for a 6-month type trade that is fairly insulated in a moderate growth slowdown scenario. And so we definitely still see opportunities in the high yield credit space, especially in asset-backed business models, I would say. So, for example, utilities. Utilities with like the telecom communication masts. In Germany, that's a big story for us. Another theme that I would just highlight that we also think is very interesting in the fixed income space, especially, is financials. So financials are obviously quite a tricky, complex, sector across, fixed income and equities, because they're very regulatory driven, quite political as well. And so, especially in the more subordinate parts of financial bank debt, there are quite attractive opportunities to invest in high-grade top issuers like UBS, Deutsche Bank, BNP, Santander, but getting quite attractive spreads, call it 300, 400, 500 basis points over treasuries for paper that is, again, callable in 2 to 3 years. So assuming you dodge the likes of Credit Suisse, obviously, which was quite an idiosyncratic event in this bank debt space, again, with quite a selective view, there are quite some attractive opportunities there as well.
I will add, I will be also on the defensive side on the credit and high yield. The level of spreads also over the past 2-3 weeks have widened quite substantially. Are still far. I think we are in the 20% narrowest spread over the past 20 years, and we used to be in the 5% maximum narrowest spread. So spreads are very, very low. If you take into account uncertainty, assuming historical default, you end up with nothing more than investment grade type of spreads. So we definitively prefer the quality to the high yield spectrum. I share the view that there are some sectors, and the financials probably is a good area where you can still find some relatively defensive spreads. But generally speaking, we prefer moving the risk towards duration. If you decompose all the risk premium, you see that you are well paid now, much above even equilibrium rate by the Fed or than historically. So you need to be very aggressive on the inflation assumption, not to be well remunerated on the rate side, especially US, but also Europe. And Switzerland is another story. And on top of that, it's more, let's say, exotic in terms of risk, but we see also some value in emerging local debt. So you get some currency. I just take the example of Brazil, which is like 14% yields with only 3-4% inflation, which is now addressing their budget problems, and one of the cheapest currency ever. So not talking that you should buy Brazilian real per se, but in a diversified way, these are the kind of segments that make sense in a global portfolio.
See, just to get a perspective, a question for our audience, in fact. We'll do the reverse. Means you are supposed to ask question, I'll ask question for you. No, it's just, if you build we are in the panel of asset allocation, and you have the proportion of bonds. Now, you have treasury bonds, you have corporate bonds, then you have investment grade and high yield, but most in the institutional world, we are in investment grade. Okay, how you will build this asset allocation on this? Based on treasury or based on corporate? How you want to build? What is your thinking on this part? 5 seconds, because I will answer, because I know the answer. So at least that I have my version on the corporates. Why on the corporates? The gentleman is correct. Why on the corporates? Because if you look the last 30, 40 years, the same period that we look there, they have generated on consistent way 100 basis points, 1% more than this part of the treasuries. Because why we have this? This is a secret, because all those professionals on the side of me, they know. Because on this type of things, the credit risk that we price on investment grade is, they realize is pretty low. We price quite a lot, which is this liquidity risk, name it, whatever it is. So this is the role of in asset allocation on this part, on the fixed income, that you build based on the credit. Now, is it credit right now to add on this part on investment grade or not? Okay, this is a question we share with the panel, means is the spread is well rewarded and yes. But this is pretty important element that we are trying to build here when we speak for asset allocation. That global corporates or Swiss corporate time to time on this part, which is a pretty small segment. This is why I'm saying not neglecting the part of the Swissy, but this is a pretty small part. It's 25% of the universe, on this part. It provides nice opportunity. Do not forget, in medium terms, you have always this premium that you get by being in the credit. Clearly, okay, some timing should be applied. There's some moments the spreads are wide, some moments are there, which believes that has sort of timing capacities, yes, is welcome. But asset allocation practice, okay, the role of global corporate is pretty important. Then whichever one, the question here that we discussed, if you are a retailer on this part, you can go in high yield and the others, but most of the institutional, most of the guys that observe these institutions is pretty investment grade type of business. And this is this 1% that, okay, the audience should not forget that you have got consistently since I don't know how many years, and we know the reason why we got this, so it's not a sort of mystery on this part. So this is my add on this.
Okay, thanks. I mean, in the last few years, one of the topics that was always big in terms of the panels here at the Finanzmesse was always the ESG investing. Obviously, things can change quickly. I get the impression from the political side and also in general in the media, this has subsided and it's not a very important topic anymore. But how do you see that? How important is it in your investment process? Do you have a special consideration, special ESG analysts, or is it not really that much of a topic for you?
maybe I start again. But I would say, yes, it's here to stay. It came here to stay. We have seen, in the recent times, we have seen it vanishing due to political pressure and other topics being more important currently. But we would still say that it's really here to stay, but in a pragmatic way. So I think all of the participants that really try to apply it on a let's say more dogmatic way, they have now the headwind in terms of be it asset growth, but also in terms of some certain detailed questions, how to solve certain problems when it comes to risk return versus your ESG fundamentals and convictions. Good examples for us are most investors, they focus on especially the environmental part. And we see issuers like, for example, in the Californian wildfires. Recently, this year, it has been a big topic. They can't get around it. They really need to embrace that topic, how to apply, let's say, not only regularities, but also how to govern these topics for their fundamental situation. I mean, these wildfires, they will not go away in the next coming decades. We will have more wildfires year by year. So these issues are forced by nature to really find a way. And I think that's also where investors are quite aware of the topic. We also found out with our empirical research that, for example, focusing on the G part, on the governance part, can also enhance your return, your risk profile. As issuers that have better governance scores, if you compare it, for example, with MSCI ESG scores, they have a lower risk of being downgraded in a market turbulence environment. So I think it's really a pragmatic kind of touching the topic of ESG for us in portfolio management, and to apply it. Then I think also is getting the standard in some ways, because a lot of analysts we talk to, they are considering the ESG part, but not separating it. So I would say like 5 or 10 years ago, you saw the ESG analysts running besides the equity analyst or the fixed income bond analyst, the credit analyst. And these two parts melted more together. So it's getting an integral part of fixed income analysis.
Yes, I will confirm the tendency that pragmatism is often the good mix, good balance. I think the pendulum effect is working, because we were probably at an extreme and now we are finding, we are first going into the other extreme and then probably we're going to settle in between. That has been our position in terms of ESG integration, because it's not separate from the credit analysis, and to know the limits also of that, because it's not like a revolution. It's what we've done over the past 20 years, but it's simply a different way of doing it, and probably adding some interesting dimension in terms of governments, but also in terms of downside risk, tail risk is important for credit. So I would stick to this pragmatic approach and integrated approach.
Good. I just wanted to mention, if anybody from the audience has a question, you don't have to wait until we sort of like 4 or 5 minutes before the end. Just raise your hand. I've got a microphone and you can ask your questions so that we address really all the questions that are within the group. Another, I would say it's an eternal topic, is the passive versus active debate. And and how do you see that also in comparison to equities? I mean, there's obviously a trend to indexing almost in every asset class, but does it really make that much sense that all of the main asset classes in equities like S&P, many of the European markets, most people, they index the core? Is it sensible to do the same thing in fixed income?
See, we have a saying, the difference with equities, because all the debates that we have for equities stands for fixed income, but the hic in fixed income is like that Japan or Italy at this time increased their debt, and we needed to follow if you are in index. So more Japan, assume Japan, okay, now everybody is becoming Japan, okay, in terms of debt. But this is the problem of indexing at this time. More Japan increased debt. If you are in index tracker, more you go there. So you know you are fully loaded and you are downhill. So this is a little bit the hic there. Then all the rationale of the other, the merits of debate between active, passive, and the other, it stands, is a solution, is an opportunity, depends how people want to use. But this is the only stuff that I would say is a little bit for fixed income, that you have this, that more debt you are, more weight you are, is not the story of MAGA. More debt you have, more you need to increase. So Italy was much higher weight at this time. Okay, people that stayed there, okay, profited from the 7% until the level at 1% that it comes. Japan in the same, but this is the only stuff that I see in the fixed income that has a little bit the worry about this indexing, if this story of debt becomes so dramatic, you know. And we are not to this point, but okay, will come.
Yeah, I guess I would just add, obviously, you know, passive funds generally great for investors, you know, gives them a cheaper opportunity to access the asset class, and especially fixed income has been quite opaque in the past, you know, and there are more and more segments that are now being tapped by this. So this is a good thing. I would say it's also, you know, increases the efficiency within fixed income trading to some extent. There's more turnover. There's, you know, fixed income, especially if you go into high yield credit, you know, a lot of it is still done via voice trading, you know. So there's a big push, which I guess is helped by the inflows of the likes of ETFs to slim this all down, which in the end reduces the costs for all of us. You know, cost, I would say, though, is obviously a function of the absolute level of yields. So for an investor right now, you know, depending on which currency you're based in, you know, what kind of bank rate you can compare yourself to, you know, the cost in fixed income may not have to be your biggest concern right now, given the level of base yields is still quite high, and the level of yields that you can achieve in the market is still quite attractive. And so we, you know, see that ourselves as well, obviously, that this demand for passive is growing ever so greater, but also for the format of ETFs, which are actively managed. That can be another solution in the fixed income space to kind of combine the two elements.
Yeah. And I just get the numbers yesterday. It's a number which is quite interesting. When you look, it's from S&P Global, and it's the same. Morningstar has the same analysis between success rate for active versus passive. So you will not be surprised that on equities, I think over 5 years, it's less than 15% of the funds that are beating large cap indices. This is well known and documented. On the Govie side, it's even worse. So the strategy that are only on government debts are also losing the passive versus active rate. What is very interesting on the credit side, and there are, when you look at 3 different segments, the first segments being the investment grade. So you have 60% of the active manager after fees are beating their benchmark. So the active versus passive race is really in favor of bond investors versus equities. And this is even more true on short-dated and intermediary maturity funds, where you have a hit ratio. Last year it was 80%. It sounds crazy, but look at the number. And on the high yield side, the number are less than 50%, around 40%, because it's after fees. So the fees of high yield funds are quite high still. But what is very interesting, and I think the main reason behind is the following: when you have a credit, you are paid at 100 at the end when you buy bonds. If you have dispersion, so you have volatility, you can simply sell your bonds at 103, which are the winners of your portfolio, and sell, yes, and buy another bonds outside your portfolio at 97. you're certain by doing this to do better than the passive. It's nothing, it's not rocket science, it's just discipline. You take advantage of the dispersion. As a bondholder, you're paid at 100, so you're sure to be paid at 100. But you can exploit this dispersion and actively manage your portfolio, and you get. And I think this is, by experience, in this particular segment, we've been, I would say, relatively, without being very smart, but we've been able to exploit that with an adding value. So I'm definitively very proactive management for fixed income on the credit side when there is dispersion but no default. That's the summary.
Speaking, I think also because it's like three topics the three of you raised. I see Agim talking about this alternative indexing thing. I remember having talked about 15 years ago, and things never changed, basically. So I hardly saw any investor that had an interest in applying a different index or benchmark than the standard market cap thing, right? So I don't know what the future will bring. I think it's like with capitalism. It's hard to find a solid alternative. But this topic has never been raised again. And I think it will also take time until we are talking about that again. One thing for me is a risk that will maybe come to the market in the next years will be sovereign debt risks. And then we will see this spiral again, talking about these indices and the sovereign risks, and the investors being stuck in these indices that are mainly drawn to that sovereigns that are having more and more debt. Talking about the thing of Lennart is the technology. Technology has made a lot of innovation during the last 10, 20 years, be it on trading, but also on the product side. And then I think it comes back to what Manuel said about market efficiency. I think bond markets still are too large and too big to be hyper efficient, because there's simply way too much instruments, way too much risk factors on that market, and which allow then market participants that are active to enhance performance if they are looking, let's say, beside the plate.
Okay, we have 5 minutes left, remember. So if you have a question, raise your hand. I think it...
there's one there.
Okay, perfect.
Where do you see more volatility coming from, the GAMA side or from the corporate side? If I have to optimize the portfolio allocation, where is more volatility coming in the next year? Because you talk about the rising debts on the sovereign side, does that influence the volatility of bonds?
Personally, I think more on the credit side this time. So.
I would argue to say that volatility will arise and stay high on the Govie side, because macro and political things will stay uncertain. We'll see higher, not only let's say central bank discussion uncertainty, but also really from a macro perspective, more things may be going to change, be it the supply chains, be it the politics between the different countries. So general rate sensitivity volatility may be higher, which may flip over to corporate volatility. But for the time being, year to date, it's very interesting to see how credit spreads widened in a, from my perspective, rather slow pace, if you compare it to rates volatility in the recent weeks.
I think on that note, what was also interesting recently is how corporate credit started to cheapen, to sell off. But actually in European government bonds, all the periphery has failed to follow. So the likes of Spain, France, Italy are trading very, very resilient in the European government bond landscape, but I would also consider them credit to some extent, relative to where corporates are going. So I would fully agree, like macro volatility is here now and it's here to stay. And this eventually, it's a ticking time bomb really, has to feed through into the credit space, be it for periphery countries, we're really just a few headlines away where suddenly Macron or Italy does give in and does kind of maybe find a way to issue more debt, assuming they don't use joint issuance, but also the likes of the UK, really, like UK government bonds over in London. There's, in the local community, a big overweight building in UK government debt, but they are just really like a peripheral country in terms of their fiscal setup, and so I fully agree with, rates volatility, government bond volatility as a massive foundation to any credit investments that you take. Plus, then over time, this will feed into credit blowups, really.
I think the panel was more a conceptual discussion about fixed income, but what happened yesterday, I think we can't just let you go without a little bit of a view into the rest of the year and the next. What's the impact of what we heard yesterday? How do you see the impact on inflation, on rates, on growth? Maybe just a short comment from each one of you.
No, it feels like a stag. Was mentioned is stagflation a little bit. The first knee-jerk reaction is a little bit more inflation, at least in the perception, and then less growth. This is what is coming. It's so many elements, even in the discussion yesterday. Means if you hear the Scott Bessent at 10 o'clock, he said, okay, please don't retaliate, we can discuss. And that means is a lot of element we cannot, fortune tellers on this part. See the big picture. The big picture is on this type of things, is in the others. If this supply shock will be materialized, then the problem, the dynamic of real growth and the inflation will change a little bit on this other. If this type of thing does not materialize as big in this type of things that they are taking to deal with this fiscal spending and the others is positive for the bonds and the others, this will be a bit totally different dynamics. You will see continued rates to go a bit down on this part if we don't have the other issue. But don't forget the big picture. As we said, okay, we are heading in this world that is scarcity of capital. Is not anymore negative interest rate, at least. Okay, in Switzerland, okay, there was some discussion for negative, but this is this type of picture, and is more healthy for all of us, that are on this world. So it's difficult to do some prediction right now on this part. Let's see another round that what is going, but clearly you will see, if you see the job numbers there, the Fed and the company will begin to add one element which is pretty important for us that was mentioned a little bit, not indirectly, because Manuel said, okay, that our Sharpe ratios as performance compared to active equities are much lower. Why is lower in the fixed income? The Sharpe ratio is their performance. Okay, are more dumb people, smart people? I don't know. It's because of the market. Because we have one market. Before, okay, you need to find where the 10-year treasury is going, then the Bund follows with different dynamic, with Gilt follow and the others. Now we are having a nice dynamic that maybe some destroying of correlation is going because we are going way apart what US is doing, what Europe is doing on this part. And this is what you have the other block of China and Japan. This totally different dynamics. Maybe our ratios of active managers in fixed income will improve, just to finish with a positive note on this part, because of this correlation that is trying to create. Because until now has been one block, one-sided, and the other. So this is a nice opportunities that we have not seen it yet, but we are in some dynamics and the others. We saw it last year, if you are in Swiss francs, which was the best performance of bonds last year. Two market, Swiss market and Chinese market. Okay, correlation don't look between those two, but okay, so for the first time we have seen that Bund was going on the other side, that we always have been anchored to Bunds and the others, and then we part apart. These type of things create some opportunities. And this is maybe this world, means we are speaking for our profession on this part of the thing, is nice opportunity. And this might create this nice dynamic. And we can do the next panel next year for this type of things, active ETFs and this the correlation that is taking the market, if it's taking something.
Yeah, I'll keep it brief. I think yesterday the way I read it is that Trump and the US in general are losing quite a lot of trust in themselves, right? I mean, the way how they calculated these reciprocal tariffs is borderline wrong, basically. And so the market is kind of realizing they don't know what they're quite doing, and they don't, and also, yeah. So I think this in turn then means, what is your safe haven asset, right? Like in a growth slowdown, not the biggest shock perhaps just yet. Do you really still want to be in US assets on the back of this? It's not obvious, and so typically, when a country imposes all these tariffs, you would have expected the US dollar to strengthen and all the other currencies to weaken. Instead, what we're seeing overnight, euro versus the dollar is convexly moving up. The dollar is selling off a lot. People are getting out of their US positions because they're saying, I don't want to be invested in this market. But then where do you go, right? Because Germany just abandoned its debt brake. Periphery, as we discussed, quite on the jittery side as well. So it's not obvious if you no longer want treasuries to be your safe haven asset, where you go next. And so near term, stagflationary, fully get it. Medium term, I think it's a question of rates volatility, but also one, and again on a positive note now as well, one that will make fixed income markets attractive for longer. There will be yields, there will be opportunities, higher yields that reward us in a better fashion. And so it's quite an exciting, also stressful, of course, with Trump. The year already feels quite long, but quite an exciting environment to be invested in fixed income, I think.
Also, to keep it short, I think the anchor of all the financial system was on the dollar and the treasury, and using treasury as collateral for trade, as collateral for financial transaction. So attacking or shaking, let's say, these two components of the financial system will have, I think, large ramification in terms of risk. So where we're going to end up is difficult to say, but I think the kind of U.S. exceptionalism is over to a larger extent, and I would prefer being a little bit outside this area for some time, at least on the risk side.
I think I can add that we have to get used to macro uncertainty, macro volatility, something market participants haven't been used to over the last, 10, 20 years. But if you look back, and I guess especially the elder of you may remember that, as far as I read it in the books of history, the 70s and the 80s were full of macro opportunities. And so if you say that the glass is half empty, then it's the real yields that worry me, the real yields in the coming years, because Agim in the beginning said it, productivity is slowing, and it will slow further with demographics. But if you look at the glass half full, we have higher yields, we have higher carry, which is a good investment for fixed income investors.
Good. Okay, with that, I would like to conclude the panel. Thank you to all the panelists, and thank you for your interest, and enjoy the rest of the Finanz.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory. New episodes are released every Tuesday and Thursday.